Mortgage rates are falling, and that should be good news. But something strange is happening. Even with cheaper loans, fewer Americans are trying to buy homes. Applications are dropping, lenders are pulling back, and confidence is quietly breaking. This video isn't about interest rates. It's about why lower rates are no longer fixing the housing market, and why they may actually be masking a much deeper problem. By the end of this video, you'll understand why the U.S. mortgage market didn't recover. It flipped, and why buyers are now taking on more risk than they realize. For years, the U.S. housing market has been explained with one simple story. When buyers disappear, interest rates are blamed. When prices rise too fast, rates are blamed again. And when something breaks, the promise is always the same. Once rates come down, everything will heal. That story is starting to fall apart. Mortgage rates have begun to ease. Headlines are celebrating it. Officials are pointing to it as proof that relief is on the way. But behind that optimism, the actual behavior of buyers is moving in the opposite direction. Fewer people are applying for mortgages. Demand is weakening. And instead of rushing back into the market, many households are quietly stepping away. That disconnect is the real signal. Because if rates were the true problem, demand would already be returning. It isn't. Recent data shows mortgage applications dropping sharply over a short period of time, even as borrowing costs drift lower. That kind of decline doesn't happen because people are waiting for a slightly better deal. It happens when confidence breaks. Buyers are no longer just reacting to monthly payments. They're questioning the entire equation. You can see it in how people are behaving. Purchase applications are no longer climbing steadily. They're falling week by week. That tells us demand is fragile, not resilient. Buyers aren't eager, they're hesitant. And hesitation is the opposite of a healthy housing recovery. The average mortgage loan size confirms this shift. Loan amounts have been shrinking, not growing. Buyers aren't stretching the way they did during previous rebounds. They're downsizing expectations, reducing exposure, or opting out entirely. When people believe prices are about to surge again, they take on more risk. When they believe uncertainty is rising, they pull back. Right now, they're pulling back. This isn't happening in isolation. It's happening alongside slower job growth, more visible layoffs, and household budgets under pressure from every direction. Insurance premiums are rising. Property taxes are climbing. Everyday costs refuse to come down. Even households that technically qualify for a mortgage are starting to ask a different question. Not can I buy, but should I? That question is far more dangerous to the housing market than high interest rates. Housing isn't a short-term decision. It's a multi-decade commitment tied to income stability, predictable expenses, and confidence in the future. When those foundations feel unstable, cheaper borrowing doesn't fix the problem. It exposes it. This is why focusing only on rates misses what's actually happening. Rates influence payments, but they don't determine whether people feel safe locking themselves into long-term debt. Right now, many buyers don't feel safe. They're looking beyond the payment and seeing a system where prices remain elevated, risks are rising, and the margin for error has vanished. When buyers start thinking this way at scale, lenders notice. Lenders don't wait for headlines. They respond to behavior. And the response is already underway. One of the clearest signals comes from credit availability. Access to mortgage credit has been tightening, not loosening. Approval standards are becoming more restrictive. Documentation requirements are increasing. Certain loan products are quietly disappearing. This is the exact opposite of what happens when a market is improving. When lenders believe conditions are stabilizing, they compete. They loosen standards. They expand access. They take on more risk. When they believe stress is building, they retreat. The fact that lenders are pulling back now, even as rates fall, tells you everything you need to know about how risk is being perceived behind the scenes. This tightening is showing up in very specific ways. Adjustable rate mortgages are becoming harder to obtain. Cash-out refinances are being discouraged. Underwriting is becoming more conservative across the board. These aren't random changes. These are the areas lenders tighten first when they believe default risk is rising. From the outside, this can feel confusing. Rates are lower, yet getting approved feels harder. But from a lender's perspective, it makes perfect sense. Underwriting isn't about optimism. It's about survival. And lenders see the same pressures households are feeling. Consumer savings built up during the pandemic are largely gone. Delinquencies on other types of debt have been rising. Wages have cooled, while fixed costs continue to climb. That combination leaves very little room for error. One unexpected expense can destabilize a household that looked fine on paper. Credit tightening doesn't cause housing slowdowns. It confirms them. It's the system's way of saying the risk profile has changed. And instead of allowing that warning to play out naturally, a new force has stepped in. Just as demand weakened and lenders pulled back, policymakers began signaling support for the mortgage market itself. The goal was simple on the surface: push rates lower, support housing, and stabilize the system. Markets reacted immediately. Mortgage-related assets surged. Housing-linked stocks jumped. Confidence, at least on Wall Street, returned almost instantly. That reaction reveals who these signals are really for. To understand why this matters, you have to understand how mortgages actually move through the system. Most lenders don't hold loans for decades. They package them into mortgage-backed securities and sell them. That process shifts risk away from the lender and keeps credit flowing. When government-linked buyers step in, that risk is reduced even further. This is why mortgage-backed securities are so powerful. They don't just affect rates, they change behavior. When lenders know risk can be offloaded, they're more willing to originate loans. When investors know the system will be supported, asset prices respond. But that doesn't mean affordability improves for buyers. In fact, the opposite often happens. When rates fall because of intervention rather than improved fundamentals, prices tend to adjust upward. Any benefit from cheaper borrowing is captured early by balance sheets and asset holders, not by first-time buyers. A small reduction in rates may shave a little off a monthly payment, but it does nothing to offset rising taxes, insurance, and maintenance costs. What this kind of intervention really does is send a message. The system will be supported. Liquidity will be provided. Disorder will be prevented. That message matters far more to institutions than it does to households trying to decide whether buying a home makes sense. This isn't about fixing affordability. It's about preventing disruption. And that distinction is critical. Because when policy focuses on stabilizing prices rather than aligning them with incomes, it preserves the system at the expense of the buyer. Prices remain elevated, risks are shifted forward, and households are encouraged to take on commitments that leave very little room for mistakes. Lower rates feel like relief because they're visible, they're easy to point to. But affordability isn't defined by rates alone. It's defined by stability, total costs, and the ability to absorb shocks. When those fundamentals are missing, cheaper money doesn't solve the problem. It delays it. And that delay comes with consequences. This is the environment buyers are stepping into right now, one where demand is weakening, credit is tightening, and support is being applied not to fix the imbalance, but to hold it in place. That combination doesn't create confidence, it creates caution. And caution is exactly what we're seeing. This is why the mortgage market hasn't recovered the way many expected. It hasn't healed. It's been flipped. Lower rates aren't pulling buyers back in. They're revealing how fragile the foundation has become. And this is only the first layer of the problem. Once policy steps directly into a market, the most important question is never whether it works. The real question is who it works for first, and who absorbs the consequences later. When mortgage rates are pushed lower through intervention, the immediate beneficiaries are not households. trying to buy their first home. The earliest beneficiaries are institutions. Mortgage lenders see volumes stabilize. Financial firms see asset values supported. Housing-linked stocks react instantly because markets understand what support really means. Risk has not disappeared. It has simply been transferred. Local governments benefit as well. Higher and more stable home prices expand property tax bases without requiring politically unpopular tax increases. That creates a powerful incentive to prevent meaningful price declines, even when affordability deteriorates. From a municipal perspective, falling prices strain budgets. Elevated prices keep revenue flowing. Then there are the industries that orbit housing itself. Real estate agents, title companies, inspectors, lenders, contractors, and home improvement retailers all depend on transaction volume. When sales slow, the impact spreads quickly. Lower rates can temporarily revive activity, not because homes are suddenly affordable, but because financing becomes just tolerable enough to keep deals moving. All of this supports the system. Very little of it improves the buyer's position. For households on the edge of buying, lower rates do not change the fundamentals they face. Lending standards are tighter. Down payments remain large. Monthly payments may fall slightly, but total ownership costs remain elevated. And the risk of buying at the wrong moment has increased, not decreased. In many markets, cheaper financing actually intensifies competition. Limited inventory meets renewed demand, and prices are pushed higher. Whatever benefit the buyer gains from a lower rate is often erased by a higher purchase price. The buyer ends up more leveraged, not safer. This is why rate-focused solutions tend to stabilize prices rather than restore affordability. They preserve balance sheets, they protect confidence, but they do so by shifting risk forward in time. The buyer absorbs that risk in the form of higher leverage, thinner margins, and greater exposure to unexpected costs. Lower rates feel like relief because they are immediate and visible. But relief is not the same as safety. Affordability is not defined by the mortgage payment alone. It is defined by income stability, total ownership costs, and the ability to absorb shocks. When policy prioritizes price support over those fundamentals, the people it claims to help often benefit the least. And there is a deeper problem embedded in this approach. Because once rates have been pushed down, there is very little left to pull when conditions deteriorate again. For decades, interest rates have been the primary lever used to manage housing cycles. When prices rose too quickly or demand weakened, rates were lowered. When inflation appeared, rates were raised. This cycle trained the market to believe that cheaper money was always the solution. That assumption no longer holds. Imagine mortgage rates suddenly falling back to levels seen during the pandemic. On paper, affordability would appear to improve overnight. Monthly payments would drop. Buyers sitting on the sidelines would rush back in. But that relief would be short-lived. A surge in demand would collide with limited supply, pushing prices higher once again. Within a short period, housing would become unaffordable all over again, only at a higher price level. This is exactly what happened the last time rates were pushed to extremes. Ultra-low rates did not create lasting affordability. They inflated asset prices. Homes became more expensive not because they improved, but because buyers could borrow more. Once rates rose, those higher prices remained. The problem now is that the rate lever has already been pulled too far. Rates moved from historic lows to multi-decade highs and are now drifting downward again. But each move delivers diminishing returns. A reduction of a few basis points does not meaningfully change purchasing power when prices, taxes, and insurance costs have risen by far more. This is why housing policy increasingly resembles financial stretching rather than financial repair. Monthly payments are made to look manageable, while total risk continues to rise. Just as auto loans were extended to 7 or 8 years to disguise higher prices, Housing affordability is being managed through financing tricks rather than fundamentals. Payments may look tolerable. Ownership is not becoming safer. Once rates approach their lower limits, there is nothing left to stimulate demand. At that point, the market is forced to confront price reality. The danger of repeatedly intervening before that happens is that it delays adjustment while increasing the eventual cost. Housing affordability cannot be restored by making debt cheaper forever. At some point, prices must align with incomes. When policy refuses to allow that alignment, it locks the market into a cycle of artificial support followed by sharper corrections. This brings us to the issue buyers feel most directly but often underestimate: the true cost of owning a home in today's market. Most people think affordability is about one number: the mortgage payment. That narrow focus is exactly where many buyers get into trouble. In today's housing market, the mortgage is often no longer the most dangerous expense. Everything around it is. Property taxes have climbed alongside home values, locking in higher annual obligations that do not disappear when rates fall. Insurance premiums, especially in disaster-prone regions, have surged at double-digit rates. Homeowners are being hit with increases year after year, often with little warning. HOA fees, once an afterthought, have quietly become a significant monthly burden in many communities. Maintenance costs have surged as well. Roofing, plumbing, HVAC systems, and general repairs now cost far more due to labor shortages and material inflation. When these expenses are added together, the picture changes dramatically. In many cases, homeowners are spending tens of thousands of dollars per year on non-mortgage costs alone. That money does not build equity, it does not reduce principal, and it does not go away when rates fall. This is why a question has started appearing more frequently in personal finance conversations: I can afford the mortgage, but not the maintenance. Should I buy? The honest answer is no. That question itself is a warning sign. If a budget only works when nothing goes wrong, then the budget does not work at all. Home ownership requires margin. It requires the ability to absorb surprises without panic. And right now, many buyers are operating without margin. A roof does not wait for a promotion. A plumbing failure does not care about refinancing plans. When finances are stretched thin, every unexpected expense becomes a crisis. Lenders understand this reality better than most buyers realize. On paper, a borrower may qualify. In practice, lenders see rising fixed costs, leaving households with little room for error. That awareness is part of why credit standards are tightening even as rates drift lower. Affordability has changed meaning. A payment that looks manageable today may become unmanageable within a few years, as taxes, insurance, and maintenance rise faster than wages. Buyers who stretch to get in are not buying stability. They are buying vulnerability. And this is where behavior begins to shift. For decades, buying a home was treated as a milestone you were supposed to reach as quickly as possible. Renting was framed as temporary, even irresponsible. Ownership meant progress. Waiting meant falling behind. That belief shaped generations of financial decisions. That belief is now breaking. What's changing in the housing market isn't just pricing or interest rates, it's psychology. Buyers are beginning to reassess assumptions that once felt unquestionable. They're no longer asking how fast they can get in. They're asking whether getting in actually makes sense. This shift isn't driven by fear. It's driven by math. In many parts of the country, the total cost of owning a home now far exceeds the cost of renting a comparable one. When property taxes, insurance, HOA fees, and maintenance are added to the mortgage payment, ownership often becomes the more expensive and more unpredictable option. Rent may rise over time, but it doesn't come with surprise roof. Replacements, emergency plumbing failures, or insurance premium spikes that reset every year. Liquidity matters again. Renters preserve cash. They avoid tying up savings and down payments. They maintain flexibility in a job market that no longer offers the stability it once did. At a time when layoffs appear without warning and career paths are less linear, flexibility has become a form of financial security. Ownership used to provide that security. Today, in many cases, it removes it. This is why waiting no longer feels like indecision. It feels like discipline. Buyers are realizing that timing matters more than labels. Ownership only builds wealth when prices, income, and ownership costs are aligned. When they are not, buying becomes a risk transfer mechanism. The buyer absorbs rising fixed costs, shrinking margins, and the possibility that a single unexpected expense could destabilize their finances. This realization is quietly reshaping behavior across the market. People are choosing smaller spaces. They are delaying purchases. Some are opting out entirely. Others are renting intentionally, not because they failed to buy, but because buying no longer passes a basic stress test. This change in behavior is exactly what falling mortgage rates were supposed to prevent. Lower rates were meant to restore confidence. Instead, they have highlighted how fragile confidence has become. Because confidence doesn't come from cheaper debt. It comes from stability. And stability is exactly what the housing market is struggling to provide. Prices remain elevated. Ownership costs continue to rise. Credit is tightening. Policy intervention is focused on supporting asset values rather than allowing price discovery. That combination doesn't rebuild trust, it postpones adjustment. This is why the mortgage market feels strange right now. Rates are drifting down, but demand isn't responding the way it used to. Lenders are cautious, buyers are hesitant. Everyone is waiting for something that hasn't arrived yet: alignment. Without alignment, activity becomes forced rather than organic. Transactions happen, but confidence doesn't return. And when confidence doesn't return, markets don't heal. They stall. The uncomfortable truth is that affordability cannot be engineered indefinitely through financing. You cannot make something affordable by stretching debt terms, suppressing rates, and shifting risk forward forever. At some point, prices must reconnect with incomes. When that reconnection is delayed, the eventual adjustment becomes more painful. This is why falling mortgage rates are not a sign of recovery. They are a signal that the system is being supported because it cannot stabilize on its own. And support, while effective in the short term, comes at a cost. Each intervention reduces future options. Each delay increases imbalance. Each attempt to preserve yesterday's prices makes tomorrow's correction more difficult. The buyers who will come out ahead in this cycle will not be the ones who rushed back in at the first sign of cheaper money. They will be the ones who waited for fundamentals to make sense again. They will be the ones who refused to confuse affordability with monthly payments, who understood that ownership without margin is not security, it's exposure. The market still sells the idea that buying is always better than renting. But that narrative was built in a very different environment, one where prices tracked incomes, ownership costs were predictable, and buying did not require stretching every dollar to its limit. That environment no longer exists. Today's housing market requires a different mindset, one that values resilience over speed, flexibility over status, and patience over pressure. This doesn't mean home ownership is dead. It means the conditions that made it universally beneficial have changed. And pretending otherwise doesn't protect buyers. It puts them at risk. The most important shift happening right now isn't in rates, prices, or policy. It's in awareness. Buyers are starting to see the system clearly. They're recognizing that support doesn't equal health, and that cheaper debt doesn't equal safety. That awareness is powerful. Because once buyers stop believing that action is always better than patience, the market loses its ability to self-propel on optimism alone. Decisions become slower, more deliberate, more grounded. And that is why this moment matters. The U.S. housing market isn't collapsing, but it isn't healing either. It's being held in place while pressure builds beneath the surface. Falling mortgage rates haven't restored confidence. They've revealed how much of it is gone. Until prices, incomes, and ownership costs realign, that confidence won't return. No matter how low rates go, the buyers who recognize this now won't feel regret later. They'll feel relief because they didn't walk blind into the biggest financial decision of their lives. They waited for the math to work. And when the math works again, confidence will return naturally, not because it was engineered, but because it was earned.